Good day, everyone. We are pleased to welcome Anita Somani and Puneet Kalra, partners in Audit and Assurance BDO India, to help us navigate the US regulatory landscape SEC updates in today's session of Insync with BDO India. Thank you for joining us, Anita and Puneet. Over to you, Anita, to take this forward.
Hello everyone, trust you all had happy and safe Deepavali. My name is Anita Sumani and I am US Assurance and Capital Market Leader in BDO India LLP. In today's session, I'm being joined by Puneet Kalra, my colleague partner. This edition of Insync session today focuses on the type of issues which have been raised in the SEC comment letters which have been received by the registrants. The content of this presentation primarily includes an overview of the SEC comment letters, and thereafter we have a detailed discussion about some of the key comment areas and SEC's expectation around the disclosure and presentation relating to those matters. To give you an overview, let us understand that the SEC staff selects the registrant's filing for review once in 3 years using a risk-based approach for the selection. Thereafter, they provide their observation or seek clarification in the form of comment letters. To provide you an overview, we have been witnessing an increasing trend in the count of SEC's comment letters over the past few years. As presented on the slide, the SEC staff comment letters have increased from 1,650 in 2023 to 1,700 in 2024. We can see on the chart here that SEC comment letter for small companies showing an increasing trend. Hence, it is imperative for us to understand what are the areas SEC focuses on, and so that any pitfall can be avoided. During the year 2024, which is the period from July 1, 2023 to June 30, 2024, the key areas where the registrants have received maximum comments are these six, which has been put up on the slide. First is MD&A, second is non-GAAP financial measures, segment reporting, revenue recognition, goodwill and intangible assets, and business combination. However, it can be clearly seen that MD&A and non-GAAP financial measures were part of the maximum comment letters. As you can see it on the slide, 34% of the comment letters were relating to the MD&A matters, one or the other MD&A matters. Similarly, 32% of the comment letters included a comment about the non-GAAP measures. While in general there is increase in number of comment letters for each of these topics, however, we have witnessed a 100% increase in MD&A related comment matters and 50% increase in the non-GAAP related matters. This next slide summarizes some of the key consideration for the company while responding to SEC comment letter. First, it is very important for a registrant to summarize how they have arrived to their disclosure or accounting conclusion. One of the other things to bear in mind that the response time is expected 10 business days. An extension can be requested. The registrar also has an option to call the SEC staff, however, only for clarification and internal feedback. The comment letters, once resolved, is posted on the SEC's website. Also, the registrant should file all response letter on EDGAR, redacting any specific information for which they are seeking confidential treatment. The registrant should also maintain a robust documentation for all the significant accounting and disclosure decisions taken by them throughout the year. The registrant should also ensure while drafting the response letter that all inputs have been considered, which includes the input from the internal personnel and the external advisor to try and address the specific questions asked and support it with the authoritative literature and guidance. The third point is to consider materiality while responding for immaterial accounting matters. Fourth, if there is a unique facts or circumstance or judgments made in applying the relevant guidance, consider including these in your response letters. Fifth, avoid over reliance on how others have responded to the similar matter. The fact and circumstances for them can be different, which may not be very apparently, which may not be very apparent from the reading of the response letter. Um, so these are the consideration while you are drafting a response letter for it. Also, be ready for the information and data which may be required if a revised disclosure has to be provided. The last but not least, an important information is about for accelerated filers and large accelerated filers or well-known season issuers, they are required to disclose the unresolved comment at the time of their annual filing. Provided the comment is material, it was issued more than 180 days before the end of fiscal year, which is included in the annual report. And third, C is it remained unresolved at the date of filing of their Form 10K or 20F as the case may be. Well, having said that, let's deep dive into each of the comment areas we discussed on our previous slide. From here on, I hand over this presentation to my colleague Puneet Kalra. Thank you all for joining us, and over to you, Puneet.
Anita, for covering overview on key themes and key trends of the SEC comment letters which the companies are receiving over 2023 and 2024. It was also important and interesting to understand how those percentages are changing between different trends and themes over different years. And it was also very, very informative to understand what are the key responsibilities of SEC issuers once they receive the SEC comment letters on their previously filed financial statements. In this current section, we will cover each of those trends, themes in detail, and we'll cover the matters which the SEC comment letters are highlighting and what are the SEC expectations from the issuers while they prepare the financial statement at first, and also while they make amendments to the filed financial statements on receipt of the SEC comment letters. My name is Puneet Kara. I'm a partner with the US assurance practice of BDO India. I work with companies which are listed in the US or which are in the process of getting listed out in the US capital market. So the first theme that we'll cover is management discussion and analysis, also known as MD&A. This is item number 7 in Form 10K. As you would have seen in the previous slides, about 34% of SEC comments are coming on MD&A section, which typically means that this is a common ground where SEC is focusing in detail and where the issuers are making deficient disclosures in their financial statements. The SEC staff comments cover various aspects of MD&A disclosures, focusing on results of operations, liquidity and capital resources, critical accounting estimates, and key financial and operating matrices. In the table below, we've highlighted various sub-themes within the MD&A sections where the SEC is focusing and where the comments are received by the filers. So the first theme we'll cover is results of operation section within the MD&A. The SEC has highlighted deficiencies on quantitative and the qualitative factors definition. So they have highlighted that the issuers are not disclosing the qualitative and the quantitative factors which are impacting the results of operations. So the SEC staff expectation is that the issuer should disclose each factor that contributed to material period-to-period changes in the results of operations, any underlying business and economic factors that impacted the results of operations, and any material offsetting factors which impact the results of operations of the company. For example, in one of the SEC comment letters, we noted that the SEC staff has requested a change in the disclosure of management, where management had initially described that the revenue from operations has increased in the current year because of change in quantity and changes in the price. However, the requirement of SEC is that the disclosure should include impact of the change in quantity and also the impact of the change in price. So the disclosure has to be very, very specific and not generic in nature. They should also define each of those factors in details. SEC has also, highlighted that the disclosures are deficient where the unusual or infrequent events are not defined within the MD&A section, and its impact on the results of operation is also not disclosed properly. For example, if the company is in a sector where there is an impact on the operations of the company because of the ongoing wars, so the expectation of the SEC is that the disclosure should disclose that particular unusual or infrequent event, and also the impact of those unusual or infrequent events on the results of operation of the company. The third theme coming out from the SEC comments is that the disclosures are deficient, where the issuer are not giving insight into the significant components of revenue or expenses of the company. So the expectation is that the issuer should disclose details of revenue attributable to significant new customers, along with changes in the price and quantity. They should also disclose acquisitions and organic growth of the business impacting the results of operations. They are also requiring disclosures of each of the components of cost of sale, which is an important metrics while the company measures the gross margins. Uh, the fourth key trend, the fourth key issue or matter highlighted by the SEC in their comment letters is that the issuer is not disclosing the trends and events that are reasonably likely to have a material impact on the revenue expenses from the continuing operations of the company. So these wars or any blockade, say in Suez Canal, if that is impacting the results of operations of the company, then the management should also disclose those events in their FDNA section. Last but not the least, we've also noted that the management is getting comment letters where the SEC staff is highlighting that the way the reportable segments are defined in the MD&A section are not in line with how they have been defined in the segment disclosures in the F pages. So the key terms, the measurement matrices, etc., should be looked at. They should be consistent and they should be properly defined at both places. So the second key trend in the MD&A section is that the disclosures are deficient where the management is defining its key financial matrices, key financial performance indicators. So the SEC's expectation is that the SEC filer should disclose the definition of key matrices and KPIs. They should give a breakout of non-GAAP to GAAP. They should also disclose reasons why those matrices or KPIs are useful for the assessment of the business and how the management is using those KPIs and matrices to measure its own performance. Any assumption or estimates while defining or calculating those KPIs is also very important to get disclosed. Any reasons of changes in the methods of how those KPIs are measured within different years is also required to be disclosed. The third key theme within MD&A section is in the liquidity and capital resources section, where the SEC's expectation is that the issuer should disclose availability of cash to fund liquidity needs. They should also disclose key drivers of changes in operating, investing, and financing activities. They should also disclose any known trends and uncertainties affecting future sources and uses of cash, material cash requirements, general purpose, and anticipated sources of fund. Uh, the SEC staff is also highlighting there are deficient disclosures in the critical accounting estimate sections of MD&A as well. The SEC's expectation is that the issuer should properly disclose the variabilities and the quality of significant judgments and assumptions, any uncertainties involved in applying those principles at any given point in time. They should cross-reference to the footnote disclosures in the F pages, and they should also present the sensitivities of those accounting estimates. What impact will it have on the financial results of the company? Other matters include, disclosures and information on the impact of emerging trends affecting the macroeconomic environment of the company. These are also some of the key matters which are highlighted in the SEC comment letters of the company. So the second theme that we'll cover is on the non-GAAP financial measures. As you would have seen in the earlier slides, about 32% of the SEC comment letters are focused on non-GAAP financial measures. Again, this is a key hunting ground for the SEC, and where the SEC issuers are making deficient disclosures. The non-GAAP financial measures include some of the KPIs that the management indicates are pretty important to measure the financial performance of the business. So therefore, in the subsequent slides, we'll cover some of the matters that the SEC staff has been highlighting where the issuers are making deficient disclosures. A non-GAAP financial measure is a numerical measure of a registrant's historical or future financial performance, financial position, or cash flows that excludes or includes amounts from the most directly comparable GAAP measures. So these non-GAAP financial measures are EBITDA, EBIT, adjusted revenue, fund from operations. So typically, management discloses non-GAAP financial measures to help investors understand how management views the company's performance. So a few of the matters that the SEC has been highlighting in the non-GAAP financial measures section is that the issuers are giving undue prominence to non-GAAP measures. So the SEC's expectation is that the filer should give equal or greater prominence to GAAP measures as compared to non-GAAP financial measures. So there have been instances where SEC has highlighted that the non-GAAP financial measures have been used, say, 10 times. However, in the F pages or in the overall 10K, GAAP measure has been used only, say, 8 times. So thereby, undue prominence is given by the issuer to the non-GAAP measures vis-a-vis the GAAP measure. The other matter that has been highlighted is that the reconciliation of GAAP and non-GAAP, the reconciliation is basically starting with a non-GAAP measure. However, the SEC's expectation and requirement is that the reconciliation should in fact start with the GAAP measure and then do all the adjustments and lead to the non-GAAP financial measures that are disclosed by the company. It's also been highlighted that the issuers are doing misleading adjustments in their GAAP to non-GAAP RICO, which could probably mislead or render the GAAP presentation inappropriate in the financial statements. The other problem that has been highlighted, or matter that has been highlighted by the SEC, is that some of the adjustment render the accounting principles individually tailored. So I'll explain that. So for example, the IFRS 15 or AC 606 requires a particular expense to be netted off against revenue, right? So that has been disclosed in the F pages. However, while calculating non-GAAP financial measures, that adjustment is totally reversed. So thereby, the SEC is kind of challenging that the non-GAAP presentation is basically very, very different than the GAAP presentation, and it is rendering, in fact, the GAAP presentation individually tailored and misleading to the users of the financial statements. There have been matters that have been highlighted where the SEC filers are doing unclear labeling, inappropriate titles have been used, descriptions are not properly defined. So the requirement is that the issuer should use titles, labels, and descriptions in line with the SEC regulations, nomenclature. There are regulation SX on the disclosures. So those regulations SX define the clear titles, labels, and descriptions that the filer should use. So the requirement is that even in the non-GAAP section, the filer should use the same titles, labels, and descriptions. The management is not defining or describing in detail how those non-GAAP financial measures are useful, to the company. So that is also a requirement that the company should disclose in appropriate detail. Why do they think that the non-GAAP financial measures, provide more useful information than the GAAP financial measure? So the third theme that we'll cover is on segment reporting. As have been covered in the previous slide as well, 15% of the SEC comment letters focus on the segment reporting theme. SEC has also been evolving as with the clients. So currently, while reviewing the segment reporting, the SEC staff also considers information that is available on registrant's public domain, available in the public filing, available in the company's earnings calls, website, industry presentations, or analyst presentations. There have been instances, where the companies have been questioned by the SEC and they've been asked to revise or explain any inconsistencies between what they've been describing in the public documents and what they've been describing in the in the form 10K. So therefore, it is very important for the companies at large to reconcile or to kind of adjust any public filings, any information in the public domain, and take them into account while they kind of freeze the segment reporting disclosures in the Form 10. The segment reporting guidance is based on a management approach principle. That means the segment disclosures should reflect our registrar's internal reporting structures to enable investors to view the company in the same way as the management does. A critical element of this analysis is identification of the chief operating decision maker, which is also known as the CODM. For this, the SEC requires that the company should properly disclose or reflect what are the different organizational structures within the company, what are the roles and responsibilities of different leaders, how they kind of integrated, and the reporting lines to the leaders. What are the kind of interactions? What are the kind of reviews that are happening between different leaders? So that these analysis basically required, or these disclosures are basically required to assess whether the company has identified its CODM properly or not. It's an important analysis, and there are many instances where the SEC has come back and sought for more information to validate whether the company's assessment is made correctly or not. The segment reporting guidance is typically governed by ASC 280. And there have been matters or there have been comment letters where the SEC has questioned the filers on the identification of reportable segments, which typically means that the disclosures regarding how the CODM goes about the allocation of resources should be made. Management structures from top to down, how they are probably assessed and assigned to evaluate the operating segments, how the budget allocation is happening, whether they are different business leaders, they are different line of businesses leaders, who are kind of heading a particular product or a particular service or a particular domain, and how their compensations are evaluated, how their performances are evaluated, in order to assess whether the identification of operating segment is made properly or not. There've been matters, or there've been comment letters to the companies where the SEC has sought evaluations regarding how the company has aggregated various operating segments, whether it is on the basis of economical similarity between different segments, or there are similarities on the basis of qualitative characteristics which are similar. Therefore, this continues to be a very judgmental area, and hence it is more prudent for the company to disclose as much facts as it can in the filings. There have been cases where the staff has come and sought more information regarding the profit or loss measures of the segment reporting, and there are cases where they've noted inconsistencies between how the segment reporting is done by the filer vis-a-vis the non-GAAP measures and some of the KPIs identified in the non-GAAP section of the F pages or 10K. So moving on to theme number 4, which is on revenue disclosures. In last 12 months, which is FY24, about 13% of the SEC comment letters are focusing on revenue disclosures as a theme. This same percent was 10% in FY23. So you can imagine 30% rise in comments on just revenue disclosure section. With guidances which are evolving, revenue continues to be a very judgmental area, which is an area of focus for the SEC. Most of the SEC comments on revenue recognition over the last 12 months have been focused around disaggregated revenue disclosures. The SEC staff continues to review all publicly available information, including the descriptions in MD&A section, investor presentations, earning calls, transcripts, public filings, the website of the company, to evaluate whether the objectives of disclosure requirements of ASC 606 regarding disaggregated revenue recognition or disclosure have been fulfilled or not. Under the ASC 606, registrants are required to disclose disaggregated revenue information to illustrate the nature, amount, timing, and uncertainty of revenue and the related cash flows, and how they are kind of impacted by the various economic factors that impact the company. Accordingly, the registrars should analyze characteristics and risk factors for each revenue stream to determine appropriate level of disaggregation in the revenue. If certain characteristics or risk factors which affect the revenue recognition timing, they should be evaluated as potential disclosure categories. There have been different themes that the SEC has been focused on, which are typical of the ASO 606 guidance, where they've questioned the identification of performance obligation within the contract, and they've asked questions to the filers around the criteria used to identify different performance obligations, whether they are goods or services, if it's a bundle contract. They've been questioned around whether goods or services are separate performance obligations or they should be constituted together. There have been questions around satisfaction of performance obligation. When the control is established, therefore, the determination about when the timing of the revenue recognition has to happen, whether it has to be at a point in time over a period of time. There have been questions that have been asked by the SEC to the filers regarding the remaining performance obligations, regarding the disclosures around the transaction price allocated to the remaining performance obligations which are not fulfilled yet, around when the entity expects the remaining performance obligations to get satisfied. There have been questions on the disclosure regarding the transaction price, the significant judgments that have been built in by the company, the variable considerations, rebates that are available in the contracts, methods and assumptions used while bifurcating the transaction price, the time value of money, and the non-cash considerations. So, therefore, the nutshell is the SEC has been after the companies or the issuers who are not disclosing appropriate amount of information which are useful for the public, for the users at large to understand the various intricacies of the revenue recognition standard. Moving to theme number 5, which is on goodwill and intangible assets. About 7% of the comments are focused on this particular theme. This is a new theme to enter the top 5 list. So you can imagine the amount of focus the SEC is having, the past 12 months on the judgments and the disclosures and the commentaries around the goodwill and intangible assets. The SEC staff has been consistently asking for further information regarding goodwill and intangible assets that are recorded by the company. These are generally material items on the balance sheet, and their recoverability involves a lot of judgment. Therefore, the SEC staff has been consistently asking for further information and disclosure around how the goodwill impairment tests are performed. Typically, they need more disclosures around methodologies used, estimates, and the assumptions used while doing the goodwill impairment analysis. Reporting units which are at risk of impairment in the future with lesser runway available, timing of performance of impairment and assessment, whether the company has used any sensitivity analysis for key assumptions used in the models, were there any triggering events during the year which led to impairment assessment, what were the facts and circumstances that had led to actual impairment being recorded through the year, what are the type of events that may lead to impairment of the goodwill or intangible assets in the future. SEC staff has also been asking questions around the valuation methodologies, different models that have been used, the assumptions related to those models, which are very specific to those models. There have been questions around those assumptions as well. Regarding finite lived intangible assets, there have been questions around how management has been able to determine the useful life of those intangibles. What were the assumptions used by the company behind assessment of the impairment or assessment of the useful life of those intangible assets. So therefore, the goodwill continues to be an area, or intangible assets continue to be an area which are at SEC's focus because any impairment assessment may lead to a higher charge, which could affect the results of operations of the company. So coming on to the sixth and the final major theme on the SEC comment letters is business combinations. So registrars that engage in acquisition transactions must determine whether the transaction represents a business combination or an asset acquisition. As per AC 605, this is a very significant judgment, and the accounting of a particular transaction differs if a particular transaction is a business combination and not an asset acquisition. And hence, because it is very judgmental, SEC has been asking for more information from the SEC filers so that they can assess whether the company has made a correct judgment or not. The SEC staff has been consistently asking registrars to provide their conclusions that the acquisition did or did not meet the definition of business under the criteria in AC 805. Additionally, AC 805 also requires registrars to provide disclosures for individually material business combinations. There are requirements in the standard that require disclosures around individually material business combinations, but when you aggregate them, they are material, for the business. These disclosures are required to help the user of the financial statement evaluate the nature and the financial effect of the business combination. Accordingly, the SEC staff has been coming after the filers and asking for information around how the company has applied the definition of the business. They're asking for information and disclosures around the nature of the transaction, specifying whether it is a business combination or an asset acquisition, information around the evaluations or the rationale behind how the company reached to this particular conclusion. They're asking for more information and disclosures around whether the acquisition should be combined together or whether it should be seen separately. What is the percentage of stake acquired by the company in the business combination transaction? What is the date, effective date? What is the amount of consideration? Whether there are related costs, what should be the accounting treatment, how they are disclosed in the financial statement. There are questions around significant estimates and assumptions used for calculating goodwill from these business combinations. Qualitative disclosures and the factors have been requested around goodwill disclosures also, from the SEC filers. So the other factors where the SEC has been asking the issuers for more information are on the risk factors, where there have been questions around disclosures of macroeconomic and geopolitical factors such as interest rates, economic inflation, supply chain issues, effect of wars, etc. In terms of contingencies, the SEC is asking for more information around reasonably possible losses and the range of such losses, quantitative information in case of litigations, climate-related disclosures. They've been asking for more information around errors, accounting error corrections, related internal control over financial reporting framework, impact, and disclosures around the controls and procedures. Uh, they've been asking for more and elaborate disclosures and description around the errors, how they were identified, quantification of those errors, what are the impacts on the internal control framework of the company because of those errors. So if you see, all these areas are evolving, all these areas are judgmental, all these areas are, are progressive, and therefore the SEC has been very agile, and SEC has been asking the filers for more information. So in the nutshell, the best possible way to address any comment letter is to disclose all the facts, go by the book, go by the accounting standards, whatever is the disclosure requirements. The best case scenario is to present and disclose as much as you can, just to be on the right side of the regulation. Thank you.